Hey everyone, listen closely, because silver just did something that usually only happens when somebody gets forced out. As I'm filming this, silver is sitting around 77.69 an ounce, up about 9.7% in the last day. Think about how violent that is. If you had just 100 ounces of exposure, physical, ETF, futures, whatever you use, that's roughly a $688 swing in a day. And gold didn't sit this one out either. Gold is around 49.66, up just under 4%. That's a big risk-off, you stress-on type of move. But here's what mainstream coverage keeps missing. Moves like this, straight up, this fast, often aren't new buyers suddenly got bullish. A lot of the time, it's forced liquidation ending, and then the snapback begins. What you're seeing isn't the mainstream explanation. Let me show you the three things happening right now. First, we're in a volatility regime where silver is whipping around like a thinly traded meme stock, even though it's one of the most important industrial and monetary metals on the planet. A two-digit swing in silver is not a normal day. It's the kind of day that breaks accounts. It's the kind of day where stops get hit, margin calls go out, and people don't sell because they want to. They sell because they have to. And once that forced selling runs its course, the market can do something that feels impossible if you're watching in real time. It can reverse hard. It can reverse in your face. Second, there's a positioning problem hiding inside a lot of silver exposure. Even if you never touched leverage in your life, you're still connected to a leverage chain. Dealers, market makers, funds, momentum traders, and hedgers all sit on top of each other. So when silver starts cascading down through obvious levels, it's not just one group selling, it's one group triggering the next group. That's how you get that waterfall behavior, down, 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 followed by a violent rip higher when the selling pressure finally exhausts itself. Third, while the paper market is panicking, the big picture demand story is not going away. You've got central banks still signaling a preference for hard assets. China's central bank is still adding to gold, month after month. You've got investors pouring money into precious metals exposure through ETFs. And you've got real people in the real world reacting to these price drops by trying to buy metal when it's on sale. So you get this weird split screen market. Paper selling creates the crash. Real demand creates the rebound. And right in the middle of it, you get the kind of move we're seeing today. Here's what they're not showing on CNBC. When I look at a move like silver up nearly 10% to about 77.69, I don't start by asking, what feel-good story explains this? I start by asking, who just got wiped out? Because these rips often happen after the market has already done the damage. It's like a forest fire. The headline is the flames. The real story is the dry brush that built up for months. Now, technically, silver is acting like it just put in a classic flush and reclaim. That's trader language for the market dumps through levels everybody is watching, sucks in panic selling, triggers stops, and then reverses back above those same levels. Why does that matter? Because the reclaim is the tell. If silver can hold this rebound zone, if it doesn't immediately roll over and give it all back, then you're looking at a market that may have just completed a liquidation phase. And liquidation phases are important because they reset the game. They wipe out the overleveraged players. They reduce the weak hands that sell on emotion. And they hand inventory to whoever can stay calm when everyone else is stressed. Now, I'm not saying this guarantees a straight shot higher from here. It doesn't. Silver is famous for head fakes. But when you see a move this sharp, the next few sessions matter more than the last few sessions. Here's the simple way to think about it. If silver holds roughly the high 70s area and starts building a base, just stabilizing, not mooning, that's the market telling you the forced selling is mostly done. But if silver loses this level quickly and we're right back to violent downside, that tells you the forced selling is not finished. It was just a pause. Either way, this is not sleepy normal volatility. This is structural. Now let's go deeper than technicals for a second, because the fundamentals are why these moves don't just disappear with a tweet. Silver isn't only a monetary metal. It's an industrial bottleneck. When the world builds more electrical infrastructure, solar, grids, EV components, defense electronics, silver demand doesn't politely slow down just because the futures market had a tantrum. And on the supply side, silver is not like a faucet you can turn on. A lot of silver supply comes as a byproduct of other mining, like copper, lead, zinc. That means silver production can be constrained even when silver prices are screaming higher. So when you see silver drop violently and then rip higher, there are two realities happening at once. The paper market is clearing positions, and the real-world silver story is still sitting there underneath it. That's why these sell-offs can create bizarre outcomes. You can have the price falling, while physical buyers are stepping in more aggressively. You can have the chart looking bearish, while long-term fundamentals quietly tighten. Now stack that against what gold is doing. Gold at roughly 49.66, up around 4%, tells you something important. The safety bid isn't dead. And when gold is strong while silver is whipping, it's often signaling uncertainty, stress, and repositioning across macro markets. Which brings me to the institutional layer, the part that separates a scary day from a regime change. Smart money moved before the crowd noticed. When institutions see this kind of volatility, they don't react the way retail does. Retail reacts with emotions. Is it over? Did I miss it? Should I panic? Should I chase? Institutions react with process, liquidity, positioning, exposure limits, margin impact, risk parity adjustments, hedging costs. So, when silver collapses and then explodes higher, it's often because institutional risk systems forced selling. And then once the forced selling ends, the market discovers there aren't as many sellers left as everyone assumed. And you can see the broader appetite for ETFs in the background right now. Big inflow numbers into ETFs overall. Now, I'm not saying every dollar of ETF inflows is going into silver or gold specifically. I'm saying it's evidence of a market environment where capital is moving fast, risk is being repriced fast, and positioning is being rebuilt fast. That's how you get these air pocket down and elevator up days. I've tracked this pattern through multiple cycles, and I want to take you back to a moment that still messes with people's heads, even years later, because it teaches the psychology behind what you're watching now. Stage 1, the calm before the shock. In early 2020, markets were high, confidence was high, and most people thought volatility was contained. Then stress hit, liquidity vanished in pockets of the market. Things that weren't supposed to move, moved. Stage 2, the liquidation wave. When the panic started, people sold what they could, not what they wanted to. That's a key distinction. They dumped assets to raise cash, meet margin, de-risk portfolios. Even safe assets can get sold in that phase, not because the thesis changed, but because the system demanded cash. Stage 3, the snapback. And then, once that forced selling had done the damage, the rebound started. Not gently, violently. That's how markets behave when they go from everyone needs out to wait, the sellers are gone. Stage 4, the repricing. After the snapback, the market didn't just return to normal. The world had changed, policies changed, investor behavior changed. The idea of what risk even meant changed. Now, I'm not saying we're in 2020 again exactly. The triggers are different. The politics are different. The monetary backdrop is different. But the sequence, the psychology, is remarkably similar. A fast drop that feels like the world is ending. Then a rebound that feels like it can't be real. And right in that window is where money is made and lost. Because the rebound is where people chase. And the next drop, if it comes, is where people capitulate. So where are we now? Right now, with silver ripping to roughly 77.69 and gold around 49.66, it feels like we're in that snapback phase. But the next phase hasn't been confirmed yet. The confirmation is not a price target. It's behavior. Do we stabilize or do we relapse? Let's make this personal. Because if you're watching this video, you're not watching silver for entertainment. You're watching because it affects your money, your savings, and your sense of financial control. Here's what this means for your portfolio. Scenario 1, you already hold silver. If you own physical silver, you probably don't mark to market every hour. You don't get a margin call. That's a different emotional experience. But you still feel the stress when prices crash. And you still feel the temptation when prices rip, either to chase more or to finally get out. So here's the practical question for you. Are you holding silver because you believe it's a long-term hedge and an industrial necessity? Or are you holding because you wanted a quick win? Because a quick win mindset will get wrecked in a market that can swing 10% in a day. Scenario 2, you don't hold silver, but you're thinking about it. This kind of move creates the most dangerous emotion in markets. Urgency without a plan. People see silver rip, and they feel like they're late. But the truth is, a lot of the best entries come after the first rebound, not during it, when the market either proves it can hold the new level, or it gives you a second chance on a retest. And the biggest mistake I see is people trying to time the exact low. Nobody does that consistently. Not me, not you, not the talking heads. The real skill is building a plan that survives volatility. And here's the deeper point. If this volatility is being driven by forced liquidation, then it's a process, not a single event. Processes take time, they have waves, and the wave you're in right now can make you do something irrational if you don't recognize it. So if you're watching silver and gold today, the goal isn't to predict every tick. The goal is to understand the regime we're in. A calm regime rewards patience. A volatility regime rewards discipline. Look, the question isn't whether we see more volatility. The math is clear. When silver can move nearly 10% in a day, it means leverage and liquidity are in control right now, not calm, long-term pricing. The real question is, are you positioned for what comes next? In every previous cycle where fear spiked and liquidity got weird, hard assets preserved purchasing power while paper promises got tested. Right now, silver sits around 77.69, gold sits around 49.66, and the next week of trading, especially the next couple of sessions, will tell us whether this was capitulation or just the first bounce in a longer unwind. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations, but the data tells the story. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from and give me your prediction. Where do you think silver is headed by the end of next week? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype so the algorithm knows you're here for the original. 3, next video drops soon, and I'm covering the one indicator that tends to show up right before these liquidation phases end for real. It's flashing again. You won't want to miss it. See you there.